The wheel strategy is safer and easier than any other option trading strategy. In 5 easy steps, I'm going to show you how to use this easy strategy to generate $5,000 a month or more. In the past month, I've made over $100,000 and a lot of it is from the wheel strategy. So take out some notes. This is going to be the most important video you need to watch from start to finish to create safe, passive income from someone with a track record that shows you their actual results with transparency. Liking this video makes me smile and helps me out a lot. So here's a picture of a smiling dog as a present for hitting that like button for me. The wheel strategy is my favorite strategy because it's a system and a process for entering stocks for the right price. You get to pick the price to enter the stock, and you also get to pick the price at which you exit the stock. You are in full control of your risk and your return. The wheel strategy has a lower risk than stock investing because to start, this strategy, you just buy a stock below the current price. Now, how do you do that? You use a put option. You sell a put option, and that right there is how you buy a stock for cheaper than the current value of the market at this time. I'm going to show you the position I have on SPY, QQQ, and how to pick the right strike price of other stocks you may wish to run the wheel strategy on. I completely understand that you're likely in your 30s or 40s or older and you need safe income. You need safe, passive, consistent income. Despite my age, I also depend on my portfolio income to travel and live a lifestyle on. I've only been to 20 countries in the past year, and that has come from my option trading portfolio. That's why a lower risk, consistent return and income is so attractive to me, and I hope that's also attractive to you. The wheel is perfect for that because you can make a steady $5,000 or more per month. I have a student named Denny who only does the wheel strategy, and he's made $6,500 a month for many months in a row. The biggest benefit is assignment and management is very minimal with the wheel strategy. Now, of course, there's some, so I'm going to go over that. So check this out. Number one, you want to identify a stock that you wouldn't mind owning. This can be any stock that you believe is a good long-term investment to begin running the wheel strategy on. Because after all, this is a slightly bullish strategy and you do want to like the stock that you're running the strategy on. Number two, you want to sell a put option on that stock at a strike price that is below the current market value. So say the stock is at 100, you can sell a 95 put. That means you can buy the stock for 95 instead of 100. This also means that you are agreeing to buy the stock at that strike price if it falls to that level. In exchange for taking on this obligation, you receive a premium payment up front. It enters your account right away. I like picking a put to sell around a 30 delta. I'll go over the best delta shortly, but the main thing is you want to balance collecting high income while not necessarily getting assigned. Getting assigned is fine, but collecting 2% a week for 5 weeks before finally getting assigned is better. There's nothing wrong with assignment though, since you want to own the stock. It just doesn't hurt to collect a bunch of premium and then buy the stock in the near future. Number three, if the stock price remains above the strike price that you pick, the put option will expire worthless and you get to keep the premium that you already got paid. You can then repeat this process by selling another put option at a lower strike. I have this situation currently on Alibaba, ticker symbol BABA, so let's go over this screen share real fast. All right, so let's take a look at my portfolio right now and analyze my Alibaba position. So I'm gonna go into BABA on my search. And then as you can see right here, I do have 1,000 shares of Alibaba. And I have been running the wheel strategy for a very long time on Alibaba now. And it's been incredibly profitable. As you can see here on the stock itself, I'm up $9,710. And then on the options themselves, I'm also up $6,870. So two things I'm doing right now is basically I am actually doing covered calls and selling puts. So essentially I have already ran the wheel strategy. I've already gotten assigned at $83 per share, and then I sold $89 covered calls. That's fantastic because it's above my cost basis. So my cost basis is 83, and then I have sold some $89 covered calls, and I've collected a very pretty penny for that. Now, although I have shares of Alibaba and I currently have a covered call position,
I am actually still selling put options as well. So as you can see, I have covered calls expiring on April 21st, but I'm also selling put options that are also expiring April 21st. So I have currently sold the $87 put and the $80 put. For me, this is a very genius play on the wheel strategy. This is sort of an addition to the wheel strategy, and it's actually called a covered strangle. The definition isn't so important. The fact of the matter is I am running the wheel strategy and I got put, but I'm still selling more put options. So this is a very interesting case scenario where you do want to actually do this if you like the stock and you want more of it. So for me, I already have 6.42% of my money in Alibaba. And I would not say that that is a little amount of money. However, I could move up all the way up to 10%. Also, another thing to notice, the reason why I sold put options and I'm still running the wheel strategy from its beginning, despite having a lot of shares already, is because I have sold the $89 covered call, but that is actually currently in the money. Alibaba is $92 per share. So I want more exposure into this company, and therefore I'm happy to keep running the wheel strategy despite already kind of being in the wheel strategy. And that's because I'm following my own rules. I wouldn't mind owning more Alibaba shares. I really would like to own up to 10% of my money in this company. So for me, I don't mind running the wheel strategy because I am fulfilling my rule number one, which is I like the company long term. Now, number two, when I sell a put option, the strike that I'm picking is still out of the money. So although I would be in a big position if I were to get executed, as you can tell, Alibaba is currently at $92 per share, but I have sold an $80 put, which is super out of the money, and the $87 put, which is just slightly out of the money. Although I may be put on the 87 put, it is very, very unlikely that I'm going to be put on the $80 put.
All right, so now that we talked about Alibaba and my position on it, let's talk about the number fourth thing that you have to do to run the wheel strategy successfully. If the stock price falls below the strike price and the put option is exercised, you will be required to buy the stock at that strike price. However, since you received a premium payment up front, your effective purchase price is actually lower than the strike price. You can then hold on to the stock as a long-term investment or sell a covered call option to generate additional income. The cool part here is that I've seen investors collect $2 on a stock that's $100 every single week for 10 weeks. By the time they actually get assigned at say $100 per share, they have already collected $20 or $2,000 worth of premium consistently over the last 10 weeks. So in theory, their average price is not actually 100. They collected so much premium that their average price is actually 80 because they've collected 20. Now, step number 5, the last step, is to repeat the process by selling another put option at a lower strike price, or if you do get assigned, you are just selling covered call options on that stock that you now own. Now, let's get into the small details and tricks that I have for maximizing your return while minimizing your risk. Keep in mind, I've seen other trading courses and their paid programs don't even compare to my free content. So if you appreciate this, please leave a like on this video and consider subscribing because my free stuff beats everyone else's paid stuff. I'm positive. I also do have a free newsletter where I send stocks that I am buying, including what stocks I'm running the wheel strategy on. So that's in the description below. So check it out. I'm going to jump into my portfolio. As always, I'm very transparent. I'm going to show you the current example and current positions that I have that I am running the wheel strategy on. And I specifically want to go over an example that you can also copy or at least understand why I am running the wheel strategy on certain stocks while I'm not doing that on other stocks. So keep in mind, this is the most important part. The goal of the wheel strategy is to collect premium, not to get assigned a stock right away. And that's why you'll see me in the example using options that are significantly out of the money. That's also why I like picking a delta to sell a put option between 20 and 30. If you go below 20, that's fine, but you will suffer in getting insignificant returns in excess of 20% a year. But if you go above 40 delta, well, that's basically going to increase your assignment risk to almost a coin flip 50-50. While being ready and able to take the stock is part of the plan, being assigned is the end of selling puts and getting a much lower price on the stock, and it's the beginning of generating income on the stock by selling covered calls. Nothing wrong with that, but again, it is nice to make 2% a week and keep doing that, rinsing and repeating that process for 5 to 10 to even 15 weeks if you pick a low delta. If you sold a cash secured put one time and you were assigned, you are either doing something wrong or you're terribly unlucky by picking a stock that has tanked. Cash secured put just means that you have the cash to buy the shares when you are assigned. As a coach and trader myself, I'd never really recommend naked option selling. I'm all about consistent safe income, not gambling and not unlimited risk. So when I am selling puts, I'm doing so at a 30 delta, maybe even less than that, and I am always cash secured. So if I sell a $10 strike put option, I do have the $1,000 to buy 100 shares of that put option. So selling short or cash secured puts indicates that you have the cash or the margin, I do use margin from time to time, to buy the stock if it is assigned. Be aware of any upcoming earnings reports or other events that could cause a huge movement in the stock. It is best to close or have the put expire prior to that event. However, I do sometimes sell puts before earnings, and I've done that very successfully on Tesla. I've made a lot of money on Tesla because the options will usually be very expensive, and that's not a bad thing if you're an option seller. The market knows that there is an earnings event and the implied volatility will spike for that earnings event. And this spike translates into larger premiums on the option itself. So again, it is better to avoid, but it does depend on a case-by-case basis if you want to sell a put that does include the earnings event. This is also why I run a Discord where I trade live, because it really depends. Sometimes I want to trade into earnings and sometimes I don't, based on many different factors. Now, when selling a put on the selected stock, here is the game plan as I'm going to show you the example. 7 days to 45 days is going to be the days to expiration. This offers a good premium, and at the same time, these options are decaying very fast. So you are collecting a good amount per day based on the theta decay of that option. So people ask me all the time, is it better to go 1 week or is it better to go 1 month? And I always tell people the same thing. It's very similar to real estate properties. If you can have a property that cash flows, whether you're collecting $1,000 a week or $4,000 a month, they are essentially the same thing. There is no point of going to your tenant's house and knocking on his door and saying, hey, can I get my $1,000 this week? Just let that cash flow property do its thing and collect your $4,000 per month. Options are very similar to that. I like doing monthly trading because it's a lot less work, but weekly trading is also very fun. And I will be honest, there's a slightly bigger profit on a weekly trade. So for example, it might be $1,050 per week instead of $4,000 per month, because there is a little bit more time decay on those options that are expiring in 1 week. And there's also usually a little bit more implied volatility in the short term. But regardless whether I'm going 1 week or 1 month, I'm always going for a 70% probability of out of the money, or essentially around a 30 delta or lower. If I can get a 25 delta and still get paid handsomely, I'm very happy with that, because that means I'm going to win 75% of the time, and 1 out of 4 times I will get assigned. Calculating the number of contracts you want to open based on your account size is also very important. I don't want to open up $15,000 worth of Oatly stock, which is a small cap company that I own, as that would be slightly risky as a percentage of my portfolio. While I wouldn't really care about opening a $250,000 position on SPY, since it's a large cap diversified ETF. So you want to be careful when you're running the wheel strategy. Of course, if you have a smaller portfolio, it's good to go for cheaper stocks. But be aware that you don't want to just pick cheap stocks. You want to have a combination of different stocks that you're running the strategy on, as it's never wise to put all of your eggs in one basket. Now, the last thing before I jump into an example is you want to look at closing this position. So if you've made 50% of the position in 3 days and your position is expiring in 4 weeks, then you probably want to close this position. That's because ideally you are making money over a 4-week period. But if you've already made all of your money in 3 days, there is no reason to keep holding this position until expiration unless you really, really want to get assigned. What I would do in this case scenario is I would just close the position, take my 50% gain, and then reinvest the money into another position. With all these tricks and secrets being said, now let's go over an example in my portfolio of running the wheel strategy on SPY, QQQ, and the other positions that I'm looking to open up in the near future. All right, guys, so let's take a look at my portfolio. I absolutely love the wheel strategy, and I have it on so many stocks right now. I'm running the wheel strategy on NIO. Actually, on American Airlines, I have already gotten put, and I'm just selling covered calls at this point. Another NIO shares, as I go down here, I have it on ZIM, which I have done really well 2 weeks in a row now.
still running another sell put on American Airlines despite having covered calls. I am always APS, always selling puts and calls, okay? So American Airlines, then you can see my Alibaba position. So I have a whole bunch of BABA actually, 87 put, 89 covered call, $80 put. I have recently opened up JetBlue, JD, Oatly is going really well. And then you can get into my really big positions. So obviously I have so many more positions, but I really just want to talk about SPY and Triple Q. So let's start off with SPY. This is a huge position for me. It currently compromises about 84% of my portfolio. So what I'm doing is I'm selling puts at 388. And the strike that I'm picking at 388 is pretty safe. So if I click into this 388 put, you're going to notice that my delta is not that high. In fact, it's 0.19. So for me, this is amazing. I love this type of sweet spot where the delta is between 0.15, 0.2, 0.25. What that means is every time I sell a put option, I'm going to be winning like 80, 85% of the time if I'm picking these type of deltas. So I do eventually want to get assigned. Again, I don't mind owning these companies and these ETFs, but in the meantime, I am collecting a whole lot of income on my way of acquiring the shares. Now, I just want to pinpoint my expiration days. So I have a put credit spread, which we can ignore for this video, but then you will see that I have expirations for May 19 and May 19. Now, people will always ask me, do you prefer 1 week trading, 1 month trading? The fact of the matter is, as long as it's 1 to 6 weeks out, that's more than fine. So I decided to go about 6 weeks out, and I currently have a position. And as you can see, I am up $11,000 on SPY. SPY is my #1 ETF for running the wheel strategy because it is so diversified. If you check out what's inside this, there's technology, financial services, utilities, and a whole gamut of other sectors. In fact, every single sector. Now, I want to take a look at Triple Q as well. I have 10.8% of my money in Triple Q, and I'm also doing something very similar to what you just saw with SPY. This is basically my favorite strategy. Again, the wheel, but I actually never finished doing the wheel. So whenever I sell puts and I finally get assigned, yes, I'm selling covered calls, which you already understand from this video. But even when I get put, I am still selling more puts. As you can see here, I actually have a very huge potential obligation to buy 25 contracts of Triple Q. And I am using margin, but again, I've been doing this for almost a decade, so I trust myself with margin. I never had a problem in 9 years. So I wouldn't recommend using margin. I can make a video on margin if you like. Just shoot me a comment down below, and if I get at least 15 people asking for a margin video, then I will go ahead and make it. But as you can see, I have a pretty big obligation on Triple Q, and I'm ready to buy more Triple Q. But currently the strike price is 284 and Triple Q is at 312. So the chances of me actually getting executed are slim to none. I mean, if you look at the premium, it's only 12 left, and I have already made $7,625 on this position. So that is how lucrative it is to run the wheel strategy. I mean, this is a prime example of me running the wheel. Now, if you'll notice, it is basically expiring in about a week from today, and it's only worth $300. So in my opinion, and I haven't had a chance to do this, but tomorrow I will be closing out this trade because it's already made all of the profit that I wanted to make. And at this point, there's not much point of holding it for a little bit over a week for just $300 when I'm tying up a large amount of capital. So that's something else that you want to keep in mind when you're doing the wheel strategy. If you can make a very big short-term gain, then there is no point of continuing to hold that put option. You can either roll it up higher and be a little bit more aggressive, or you can just take your profits and roll your collateral into a different trade. So you can pick another attractive trade, or you can even pick the same ETF, but just a different expiration date and a different strike price. Because basically right here, as you can see, I mean, I've just made everything. So there's no point of holding this anymore. You'll also notice if I go to my portfolio, QQQ and SPY are very heavy in my portfolio because both of them are very diversified ETFs. They have a lot inside them. I mean, for example, like airlines crashed today a bit. I mean, they went down by 9%. And yes, I have American Airlines, but I'm not panicking at all because my position in this company is not that big. And if you'll notice, Alibaba, yes, it's down 7%. However, again, my covered call right now is actually in the money. And that's something that's really interesting. This is actually something I learned at Goldman Sachs. And this is something that Mark Cuban actually did when he got a $4 billion compensation from Yahoo when he ended up selling his company. He had a whole lot of stock and he was afraid, obviously, to hold $4 billion worth of his stock. So what he wanted to do was he wanted to get out of his stock, but he couldn't because there's something called like a restriction period. as soon as you sell a company, you're not allowed to just dump your shares right away, especially $4 billion worth. I mean, that is a lot of money. So instead, what he actually did was one of his financial advisors, and I'm not sure on the exact details there, but he ended up selling covered calls, but they were in the money, similar to what I'm doing on Alibaba right now. That's actually called a collar. A collar is just a covered call, but you are selling in the money covered calls. So for example, Alibaba's at 92, but I have sold 89 covered calls, and that's in the money, and that's why the premium is so juicy. But today, Alibaba fell a lot, so literally my day's gain was $5,300 in one single day. I made $5,000, and that's because I am really hedged. Now, of course, it's basically all of my total return at this point, but that is amazing to see that the stock can fall 7%, meaning a lot of people lost a ton of money, but my wheel strategy, or my covered call here on the wheel strategy, has fully protected me, and I am very cushioned against the downside. I think the most important thing to really understand when you're running the wheel strategy is how to sell puts to begin with, because if you do that properly, then you're going to have a profitable wheel strategy. And if you want to watch the best video on YouTube about selling put options, you should check out my video right here on the screen.